The stock market is looking grim in 2018 and real estate is no different, it seems. We have a slowdown in real estate that has taken hold not just in the US, but in many major cities around the world. Rising trade tensions, rising interest rates, and the obvious threat of a full-blown collapse is taking over the markets. What will come of this? You came here for the truth, so let me unveil that for you. Today we're going to look at real estate. It's coming down right now. We look at this on a global level. I have individuals all over the world reporting to me on a daily basis of what's going on. I live in Toronto, I live in Canada, but I get these reports from people in literally all cities around the world. It's incredible to hear it directly from the grassroots and see exactly what's happening through other individuals' eyes. I think it is priceless to get that data, and individual analysts out there, they don't have that. They have to actually go to these different cities and they have to try and get a sense of it. I'm able to get these reports from people on a daily basis. It's amazing. I'm so grateful to each and every one of you. I have a lot to cover today. We're going to look into all the different markets if I can, especially US, Canada, Australia, and I'll try to talk about the UK as well. So let's begin. Sales of previously owned U.S. homes posted their largest annual decline since 2014 in October as the housing market continues to sputter due to higher mortgage rates that are reducing home affordability. I have talked about this over and over again. I always show the correlation between mortgage rates and home prices, between interest rates and equity prices. There is a complete correlation there, and we need to understand it. We need to look into it on a daily basis and see how it is affecting the actual economy as well as asset prices. Sales posted a sharp 5.1% drop compared with a year earlier, indicating that the market is likely to end the year on a sluggish note. That's what's going on right now. This is happening in the United States. I'm going to show you various examples of this. I'm going to show you some charts as well. So let's get further into it. Slowing sales. Sales of previously owned homes in the United States, you could see that it has in fact come down here along with equities as well in the United States. And you're looking at this being from a very high point. There is no doubt about that. However, the trend is down. Let's go further into this here. Yet even with the booming growth, Dallas's once vibrant housing market is sputtering. In the high-end subdivisions in the suburb of Frisco, builders are cutting prices on new homes by up to $150,000. And it doesn't matter if that home is $1 million, $150,000 off of it is significant. And that's when you know that the homes were being priced way too high. I feel bad for the people who bought at the peak, but it gives individuals the opportunity to buy at a reasonable price, hopefully if these prices continue to fall. The US economy had one of its best 6-month stretches in a decade as the unemployment rate hovers around its lowest level in half a century. But wait a second. Why are the home prices falling? Well, as it talks about here, the housing market makes up a sixth of the US economy. That shows the weakness that will be visible very clearly in short order. As mortgage rates rise, this is going to have an impact not just on these particular assets like real estate, like equities. You're going to find with the interest rate rising, you're also going to see how this affects the economy in general, and of course that will make its way around eventually. Whether it happens today or tomorrow or next week or what have you, it's all up in the air. It's dependent on the Federal Reserve and their actions. They are widely expected to increase interest rates in December. That's going to send the mortgages up even higher. Those with variable are going to be screwed over directly. In Canada, we see an interest rate increase. People are affected because they have to then refinance the property on a 5-year timeline on average. Of course, this is the way it works. I'll talk more about that in a second. But surely this is going to impact individuals in their pocketbooks, and there is no doubt about that. Home price growth has slowed for the last several months and is expected to continue slowing as mortgage rates rise. They're giving you the details about home affordability. They're talking about all of the current volume, about the issues that are present. If you want to read this, please do. This is a Wall Street Journal article. This is the chart that coincides with it. Though home prices recovered after the last downturn, building never did, leading to an oversupply. Median home value changed from a year earlier. Look at this chart going back from the 90s up until today. Yes, the home prices rose. Yes, they went up considerably. They came down during the housing crisis. They had risen up yet again. But what we see today is that the slowdown is apparent. The slowdown is here. This is completely correlated with interest rates. There's no other way to look at it. Farm bankruptcies are on the rise in the upper Midwest, according to a new report from the Fed. You could see that the farms today are dealing with a very big issue. Number one, they can't afford what they are getting themselves into when you have all of these big agribusiness that's simply putting the small and medium-sized farmer out of business. Farm bankruptcies will continue, and that is quite unfortunate because it simply puts more and more control into the hands of these big businesses, which are generally have the worst quality food. Home sales dropped nearly 6% in September. Is the boom over? This happens to be regarding Detroit. Now, I want to know any of my friends who are in Detroit, please let me know. This is very important to look at a city like this, which has obviously undergone a lot of stress over the years. It has unfortunately been met with decades of weakness, and I just wanted to know what's happening on the ground. They're saying that the prices did come up quite a bit from their low point, and it would be interesting just to see what individuals there are actually visibly looking at. Denver's once soaring housing market has run into turbulence. Sales and construction activity have slowed in recent months. Houses that would once have drawn a frenzy of offers are sitting on the market for days or weeks. Selling prices are rising more slowly, and asking prices are being slashed to attract buyers. Now, where is this? Is this Detroit? Is this in the middle of nowhere? No, it's happening right now in New York, Seattle, and even San Francisco. They are seeing the statistics that are piling up. All right, now I gotta switch gears to look at Australia for 1 second here. At a time of falling home prices in many parts of the country, this individual, Bowie, I believe his name is pronounced, from Credit Suisse, is warning that this could see residential investment falling materially. So he had said that Sydney's led national housing downturn will continue for some time, forecasting that home prices in Australia's largest and most expensive city will fall 10% this year and next, with potential downside risks. Just like with Canada, with the US, with the UK, and other places, real estate is a big part of Australia. Yes, there are many others, no doubt about that, but it makes up a fairly significant percentage. That needs to be understood because when the home prices start to decline, it has an impact not just on individuals and what they owe on their mortgages and if they're underwater and so on, it has an impact on the wider economy because suddenly you don't need as many homes. You don't need millions of homes to be sitting empty. You don't need to do what China did with the largest public works projects in the entire history of the world. You don't need that to happen. So what you do here is you, in fact, look at what's happening in the economy of this particular nation. You look at their quantitative tightening policies that they may be implementing. If that's the case, you know that it is going to be uncertain, and uncertainty always causes fragility. Where there is fragility, there will be a fall. It is inevitable. This is talking about Canada. Now, my friends in Canada, I want you to look at this right now. And if you're from some other part of the world, I want to show you this also because I think it's so interesting to look at this chart, and it's so telling because it's what I've talked about so many times before, but now I have it on one chart to show you. Numbers here are assuming a 2.99% 5-year fixed mortgage rate with a 25-year amortization. For those who don't know this, in Canada, the way it works is that you might get a 25-year mortgage, but your interest rate is not for that entire 25-year period. You would, on average, get it for a 5-year fixed because that tends to be the cheapest price. If you wanted to get a 10-year, you could, but that would be at the rate that is not so suitable. And so individuals tend to get that 5-year in many cases. This is showing the different cities, and there are 3 numbers underneath each of those cities, and the representation being average or benchmark home price, that's the top, the down payment, 20% of that, and income needed to pass the stress test. Look at this. You tell me something. Toronto, Vancouver, where most of the population of Canada lives, that's 10 million people in 2 cities, okay? So a large percentage of the population just in 2 cities. Toronto, $817,000. You need to have a down payment of $163,000, and you need to somehow have an income of $145,000 a year. The average home, $817,000, you need to somehow come up with a down payment of $163,000. Do you think that the average household has $163,000 in cash sitting around? Probably not. Do they earn, the average household, $145,000 a year? The answer is no. The answer is more like half of that, practically. Vancouver is even worse. Over $1 million average home price, you gotta have $217,000 in cash, and you gotta earn $175,000 a year. It's absurd. It's crazy. That's what the prices are. And if you ask 99% of people, they think that rising home prices are good. Why? I really don't know. The latest set of federal mortgage rules has been blowing a cool wind over almost every Canadian real estate market, with the exception of Ottawa, Montreal, and a few others. Home prices have slowed or dipped, sometimes upsetting the calculations of homeowners counting on windfall sales. The average price of a home in Canada stands at $491,000. That's down 10% from March of last year. 10% on average. Some markets better than others, some markets worse than others. But that shows us something, that the frenzy is in fact over. So you're looking at Australia, Canada, the United States, and other places. Hey, even London has familiar tones here. Look at other cities around the world as well. Things have changed big time. Canada's housing market among the world's weakest as price growth hits a 9-year low, fallen to 37th place. That's a good thing. I'm completely convinced that housing prices falling is an excellent factor. Not when it slows down by 10 or 20%. If they can come down by a nice 50%, I think that would make homes much more affordable for individuals. Still very expensive, definitely by historical terms compared to salaries. However, it would be much more realistic, and it would allow people to get into the market. There's no doubt about that. I think it would be beneficial, and hopefully that does occur. We'll see what happens. The government's going to do whatever it takes to keep these rising higher and higher, that's for sure. And last but not least, just to show you this, I think it's crazy. One individual company that bought a nice $1 billion of real estate is only the second biggest purchase this year in this area. And it happens to be, oh, that's right, the same company, Google. In a head-spinning mega deal, Google has paid $1 billion for a huge Mountain View business park, the Bay Area's largest real estate purchase this year. It is the second largest property purchase in the United States this year, eclipsed only by another Google acquisition, $2.4 billion in Manhattan. This is a company that has so much money, it is absolutely ridiculous. They're sitting on the cash, they need to spend it, they're buying up real estate in this case here, they're going to put more facilities, I'm sure they're going to be expanding on their headquarters, on their different buildings that they need for their employees and so on. It's good in a way, there's no doubt about that. I just think it's funny to see where the money goes. The money doesn't go into your pocket, into my pocket. The money goes into the biggest of the big businesses as time goes on. I'm not suggesting anything about this particular company at all. It doesn't matter to me. I don't care. I just wanted to show the great divide that is occurring between the haves and the have-nots. And today in 2018 is more present than ever before. We are in the roaring 20s, and we're going to be smashed hard in the near future. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. If you want the financial education you were not taught in school, these 2 books have it all. You can get the details that you need, everything from the foundation, the asset class, how to make money, how to reduce your debt, tax incentives, and everything else you need to know. Check it out at the link in the description. You can flip through the pages of the book for yourself. If you're more interested in the audiobook version, you can get that at themoneygps.com.